everybody. Welcome to another edition of the 1Mby1M podcast. Today, I'm here with Endiya Partners, and all the partners are on the call. So we have Sateesh Andra, we have Abhishek Srivastava, and Ramesh Byrapaneni. So we have three people very conversant with the Indian ecosystem and are investing in the ecosystem. So we're going to have a great conversation about India. Welcome to the show, Sateesh, Ramesh, and Abhishek.
Thank you, Shamina. Appreciate you having us on the show.
So let's start by each of you taking turns to introduce yourselves, your background, and how you see the India venture opportunity. Let's start with you, Sateesh.
Great. My name is Sateesh Andra. I'm one of the founders of Endiya Partners, along with Dr. Ramesh as well as Abhishek, who are on the call. My own background, I'm an engineer, electronics and communication engineering with master's in computer engineering. I spent roughly 16 odd years in Silicon Valley prior to coming back to India. Started my career in semiconductors, designing chips, PowerPC chipsets, and later, networking chips. Worked at LSI Logic, then moved from engineering into product marketing, product management. Joined a startup called T-Square that got later acquired by Connexent. While I was still actively pursuing my career in semiconductors, I used to very avidly follow internet and software ecosystems. I started a company called Euclid. It was a Silicon Valley startup. As a founder CEO, raised around $40 million of venture capital funding. We were one of the hot startups in the IT governance space. Those days, the term ASP, application service provider. Today you talk about SaaS. I've built a company. Once the company exited, I wanted to move to the other side of the table. Wanted to work with great entrepreneurs. I was a venture partner with DFJ. I was with them for 5+ years before I realized my calling, that early stage, product startups. That's what I love. Partnering with entrepreneurs outside of investing capital, working with them to help them scale. Got to know Dr. Ramesh and Abhishek through TIE, and that's how Endiya Partners was born.
Very good. Let's talk about Dr. Ramesh next then. Go ahead.
Maybe I'll request Sateesh to give a quick Dr. Ramesh's background. Sateesh.
Go ahead. That's fine.
Dr. Ramesh is a cardiologist. By profession is an intervention cardiologist. Again, was in U.S., came back, started a tertiary care hospital, 300+ beds, family ran. He was CEO as well as chief cardiology. After 2.5 decades as a clinician, he wanted to work with entrepreneurs who would work on the next disruptive idea, either in digital health or medical devices or life sciences. He got actively involved at TIE, became president of TIE Hyderabad. That's kind of how I was active in the Silicon Valley TIE. That when I moved to India, again, was very active. We used to do a conference called TIE ISB Connect in association with Indian School of Business. And Dr. Ramesh left his practice and then moved into venture capital full time.
Okay. And Abhishek, what about you?
Yeah, Shamina. So I'm an engineer by background. I did my engineering from Delhi College of Engineering, Delhi University. Subsequently spent around 4.5-5 years on the enterprise product, largely on the product development side, a little bit on the marketing side, both in India and in Europe. Then did my postgrad from Indian School of Business in Hyderabad, and switched gears a bit. I was with consulting and investment banking with Deloitte Consulting, and then followed by PricewaterhouseCoopers Corporation's CFIB team, PricewaterhouseCoopers. Around 4.5 to 5 years, again, sort of very enriching learning experience, I would say. But beyond that, again, I wanted to get back into the operation side, and that's when I joined another company called Science, which is one of the leading product and network engineering companies in India, and they were on the cusp of their high growth. So I was a part of their corp dev, largely managing organic as well as inorganic growth initiatives. That's when learned a lot more around, I would say what's now called IoT. Back in those days, it was more around smart grid, certainly more on the product side, engineering side, and the network engineering side. And then almost for the last 6 years, being in the early stage, investing, working with the startups and very, very early entrepreneurs. I think like Satish mentioned, I got to know Satish through one of the Thai forums where we, ran sort of one of the first jump-started a program called Thai Buddies. We used to teach school-going kids about entrepreneurship, and that's how I got to know him and, also Dr. Ramesh, and figured out very soon that it is a kind of calling, given all the, I would say, the directions were pointing towards India becoming the next hot destination for product startups, as well as wanted to leverage my previous experience and work with Satish and Dr. Ramesh.
Great. So let's start talking about Endiya Partners. How big is the fund? What is your preference in terms of where you want to invest in, what kind of stage, and so forth? So let's understand the Endiya Partners thesis.
Our first fund, Shamina, is around 175 crores. And we've made 12 investments. And our vision was always, the co-founder VC for product startups.
And that's about 30 million, 35 million, somewhere in that.
Yeah, around 30 million. Yeah, around 30 million, depending on the exchange rates, right, any day. So we always wanted to, obviously, early days, if you remember, there were accelerators, incubators, angel investors. I mean, they all still exist. But there weren't any seed stage VC funds or pre-Series A VC funds, and that was not a category, because the angels, accelerators, investors, would do the early stage, seed and pre-Series A funding, and occasionally Series A investors would invest in startups at that stage. But we realized that obviously, seed and pre-Series A would be a category by itself, and we wanted to be a leader in that category. And co-founder VC was our tagline. Not that we would run the car from the back seat while still entrepreneurs will drive their companies. We wanted to stay very involved. Everybody in the team, we all have entrepreneurial operating experience besides wearing investor's hat. So our check size would be $500,000 to $1 million to begin with, and over the life of the company in the fund one, we invested up to $4 million per company. We've done 12 investments. Majority of them technology and healthcare companies, product startups, selective consumer bets. In terms of subsectors in technology, SaaS, cybersecurity, enterprise mobility, then hardware, semiconductors, and in the healthcare, digital health, medical devices, and healthcare IT. And on the consumer side, whether that's, again, fintech or, healthcare or certain niche retail, those are the opportunities that we look for. Broadly, 3 themes. I mean, we look at, certain set of companies going just after India market. Then a whole bunch of them start in India and then go into adjacent markets like Southeast Asia or Australia or Middle East. And some of them have presence in India, but they go global. I mean, they have nothing to do in India. They sell global markets. So those are the themes. And, our companies, Fund 1 has done really well thanks to exceptional entrepreneurs and their execution. I'd say slice of luck and a bit of a focus, all of that has helped us to achieve, good momentum so far.
So Fund 1 is all invested now?
So we will not make a new investment. We've reserved sufficient follow-on capital for the companies, portfolio companies. Fund 2, will go live soon. It'll be a $75 million fund. Pretty much the same thesis. The idea was that, we wanted to be able to do as many pro rata investments in later rounds of our portfolio companies.
And you operate out of which city in India? Hyderabad? You talked about Hyderabad earlier.
Yeah, we live in Hyderabad. We keep joking. We live in Hyderabad, but majority of the portfolio is based out of Bangalore. Out of 12, I think 7 are Bangalore, 3 in Hyderabad, 1 Bombay, and then 1 in Delhi.
Okay. So let's talk a little bit about your companies. So pick maybe 1, 2, 3 highlights of your portfolio. And as you describe them, tell us about when they came to you, in what state did you encounter them, and what is it about them that compelled you to write checks? So what I'm trying to do is understand how you think about investments in specific cases.
Sounds good. I'll talk about a few examples, and Abhishek, feel free to chime in a couple of those. Shamna, most of these checks, except 1 or 2, are concept stage checks. We're the first institutional investors. Let me talk about a company, in each of these themes that I talked about. India only, then India first, and adjacent markets next, and going global without doing much in India in terms of marketing and sales. So let's talk about, Alpha ICs. Alpha ICs is a programmable AI processor. It's an edge processor. And in terms of, there are a lot of data center focused chips. NVIDIA is the market leader, and then you have got GraphCore, Samanova, a whole bunch of, companies very well funded that are attacking the data center side. But we realize that edge inferencing is going to be a really big opportunity, and it's very important, not just data labeling, but also decision making needs to happen at the edge, especially in environments like, automotive, whether it's ADAS or autonomous vehicles. Then you look at conversational systems as well as, video surveillance or, industrial automation. In all of these environments, such processing capability, low power, but highly, high performance oriented processors were a must. We found Alpha ICs, we wrote the first check. The entrepreneur background, he was at Qualcomm and he was at NVIDIA before. So he's part of Snapdragon and Tegra teams. And I think those companies, we had more than 30, 40 patents. And even within Alpha ICs, we had multiple patents. Given my semiconductor background and the fact that, I understand the industry really well, we really liked the company, liked the entrepreneur, and we made that investment. About the CISC risk, then obviously graphics processors and the tensor flows. All these architectures, this agent-based computing, these are programmable agents, obviously, that can be defined to do a particular task. And, it's just a very, very efficient architecture ground up, and we're very excited about the company. So that's one example of, Bangalore, Silicon Valley company. Lots of engineering work gets done out of Bangalore, but the markets are U.S. and Japan and Europe.
Very interesting. As you probably know, my background is actually in computer architecture. I was in the parallel computing part of MIT's Alewife project back in the mid-90s. So one thing I've always observed is that chip companies, the funding for chip companies has gone down tremendously in Silicon Valley also, and very few, almost no one in the Indian venture ecosystem is willing or equipped to do chips. So I'm actually thrilled to hear that you are willing and equipped to do chip investments, early stage chip investments from India. So congratulations on that. Tell me a little bit about this company. How does the follow-on funding happen? Are any of your colleagues in India willing to fund the chip company, or did you raise the follow-on funding in Silicon Valley?
So I think we were lucky that in the initial round itself, we had some of the investors from around the globe, from Japan as well as Europe, and Vinod Dham is actively involved, with this company. A couple of co-founders sit out of Bay Area, and so given that the markets are in U.S. and Europe and Japan, and the fact that there were a couple of investors who got involved early on, we feel fairly confident. Within India, still, I must say, things are changing quite a bit in terms of VC's interest in investing, in some of the deep tech companies, but we're still in early days. So while we may get, some follow-on capital from India, but majority of the capital will come from outside of India for this company.
Yeah. So how far along is the company? Has the chip been finished, or where are you?
Yeah, no, you come from that industry, right? I think they initially got the logic, prototypes in FPGAs, though they run slower, right? But
yes.
At the same time, you need to build a compiler, you need to build all the libraries. So all of that is done, and the application boards are built with FPGA samples that are running the entire logic. May not be at the final clock speed when the chip comes out. I think they're about to tape out the test chip. The initial benchmarking has been very, very encouraging, and we are very positive. Once the tape out is done, we characterize and we plug the chip in the application boards that we have ready already, and many customers are kind of piloting them in various application scenarios.
Very cool. All right, let's talk about maybe another one or two examples of what.
So let me talk about another SaaS example here. Another example from SaaS, a company called Darwinbox. Again, we wrote the first $300,000 check to 3 entrepreneurs. What they build is a HR SaaS platform, end-to-end, hire to retire. In terms of, when like the entire HR life cycle, you've got recruitment and induction, that's one function. Leave attendance, payroll, compliance is the second function, which is closer to finance, so it sits in HR. And then you've got engagement, you've got learning and development, and performance management. Performance management becomes the seraphim. So the team, came from Google, E&Y, McKinsey, IIT, IIM, XLRI kind of background. So not so much about the educational credentials or industry experience, but I think they understood the domain really well. As Indian economy, kind of doubles and triples, grows to close to $10 trillion in the next 2 decades, so many more companies are going to grow. Many $100 million companies are going to become billion-dollar companies, and we all know that the most precious capital is going to be human capital. And obviously, many of these mid-sized companies do not have a HR system. Today, at best, they run leave attendance, payroll, payroll processing, and some of them use recruitment solutions. So we knew that while there could be a lot of homegrown local companies, and occasionally, an SAP or an Oracle or a Workday would try and, obviously sell to India customers, we strongly believe that there is room for an India company to grow, build a large business in India, but also go and sell in the adjacent markets like Southeast Asia. So we wrote that check. Company had version 1.0 basic MVP, I would call it, with few pilots. Fabulous entrepreneurs again here. So they did really well, scaled, their business. Lightspeed Partners invested after we funded the company. Very glad to say that they have 100+ enterprise customers, a couple of 100,000 employees from these enterprises using the platform. And they're already in Singapore, and they've got initial set of design wins, and they're very rapidly scaling.
So what about Greytip?
Yeah, so folks like Greytip, others are local HR plays, but they may be going after the low-end segment, right? So there's a small, medium enterprises, and then there's medium to mid-sized to large, and then there are the large enterprises and MNCs. So occasionally Darwinbox may see a Greytip, but they don't compete with them in many of the accounts. They compete with SAP SuccessFactors. Occasionally they see Oracle, and there's another services-driven company in India called PeopleStrong. They also see PeopleStrong in certain accounts, but Darwinbox is making very rapid progress. Okay, very good. All right. Do you want to talk about any other company, and then I'm going to switch? I'll switch to one India team, an India team company, but I'll also let Abhishek. Abhishek already managed the company. We had an exit within first 3 years. It was a cybersecurity company that was selling both in Europe, US, and India. I'll let Abhishek talk about that. But an India team, a company called KIST. KISSHT, KIST, it seems in Hindi means payments. KIST is a fintech company, purchase financing. They enable purchase financing, consumer durables, like if somebody is buying, a mobile phone, or if somebody is buying electronics or a laptop, they can buy now, pay later, pay in EMIs. The technology they have is determining the credit scores of consumers. In India, CIBIL is just evolving. It's not like Experian, Equifax, and TransUnion, the established credit databases that we have in US. So apart from CIBIL, they look at alternate data sources like employment and salary information, bank savings, also the behavior and the credibility in the digital footprint. And they use all of the data to determine the creditworthiness. They also have collections, automation. How do you collect the money? Disbursing is one piece, but how do you, collect the money on an ongoing basis? And then third piece is the fraud database. So that's the tech platform, and they leverage that to deliver this purchase financing services. And they just started even a bit of personal loan portfolio. And they acquire customers through multiple channels, online, majority of the large online players. For example, bunch of stuff on Flipkart, KIST services. They have OEMs like, the Dells and LGs and Samsungs that also drive the business, and they also have offline. Again, we wrote the first seed check for $1 million. This is India-centric play. The company has raised, close to 40-odd million, 35 or $40 million, and they've done really well.
Great. So I actually have a question on companies that are raising a lot of follow-on capital. For a small fund like you, companies that end up raising a lot of follow-on capital, what is your take on those situations? Do you exit into follow-on rounds, or do you stay put?
We did not exit any of these companies. We did seed investment. We did pro-rata in Series A. We did in pro-rata in Series B. Like I said earlier, in terms of our Fund 2 strategy, the reason why we increased the size to $75 million is to be able to do many more pro-rata rounds for our portfolio companies. But it's not that our intention is to stay in these companies forever. neither would be too aggressive in selling them early nor get too greedy and wait there forever. We understand that as a seed investor, when large capitalization, large rounds of funding happen at the right time, we need to exit. But so far, whether in KIST or Sictapol or many other companies that have raised rounds, follow-on rounds of funding, we've not executed. We believe in these companies and they're exceptional entrepreneurs building good products and scaling these companies.
Yeah, I think that's true about what's happening in the venture market in general. There has been a lot of infusion of capital in the, pre-seed, seed, post-seed, Series A, small Series A stage. Not the traditional 5 million, 8, 10 million Series A, which is the bigger funds are doing these 5 million, 10 million Series A, but there are a lot of hundreds of funds that are now playing in your part of the ecosystem. And I think to counter the other side of the trend, which is SoftBank and NEA all kind of putting in huge amounts of money in later rounds, I think it's better for smaller funds to take the money out at this point, because sometimes these very large rounds are going to be stuck there for a while and not get exits because they're overvalued rounds. So,
let me clarify, Shamina. Let me clarify. I completely understand what you're saying. So let me kind of give you an idea of what we call as either seed or pre-Series A, and what is Series A, what is Series B, what is Series C. Our seed rounds or pre-Series A rounds are less than $2 million.
Yeah.
Right? Series A's are anywhere between $8 to $10 million.
Mm-hmm.
Series B's are, $25 to $30 million, and above that is Series C and Series D. You're absolutely right. If you look at, let's say, I put in $1 million or $2 million early on, and I own 10 to 15% of the company, right?
Yeah.
In a $10 million round, to maintain the pro rata, I need to put another $1 million or $1.5 million.
Yeah.
Right? And in a Series B of 20 million, again, I need to put in $2 million. Right? So you're talking about $4 million per company, $4 to $5 million per company to participate in every round, and defining these rounds are similar to, a Valley or any other, kind of metro market sizes of rounds. You're absolutely right. If they honor us, term sheets in terms of liquidation preferences or shareholder rights, and if you're not participating in those rounds, obviously you have to make a decision whether staying in makes sense in spite of the risks, or it's better for you to get out.
Yeah.
I must tell you that thanks to our great entrepreneurs and I think our own due diligence and slice of luck, in almost all our companies, we were able to participate, and we've got great rights in both seats.
Yeah,
right?
But as you go along, it's going to come up. The exit question is going to come up just because, fintech, for instance, it's going to take a while. Yeah. It's going to be a lengthy journey. Fintech in India, it's going to take a while to build this company. So quite possibly you'll have to consider those possibilities. It's just I think it's okay. The important thing is to make sure that each part of the ecosystem is healthy, right? If you look at the early days of the India early stage ecosystem, especially the seed stage ecosystem, the angels were getting very nervous because exits were not happening, and a lot of angels had their money stuck for a long time. Now I think with all these development and the understanding of the later round investors buying out the pre-seed, seed, angel kind of money, I think there's more. The ecosystem is becoming healthier, and that's a very good trend.
Yeah, no, I completely agree with you. I'm not. I think there are. One needs to monitor the situations and be very careful, not get stuck, but at the same time, sometimes not exit too early.
Yeah,
you minimize the
judgment.
So I think one has to be very, very careful. No doubt about it.
So Abhishek, you wanted to talk about one of your companies that has already had an exit. Would you like to get going?
Sure, Shabana. This is actually a company called Shield Square, which is into cybersecurity. And what they had built is they had built a cloud-based, real-time bot prevention solution. Essentially, if you look at it, the verticals, which is, I would say, any online digital asset, whether it's in the form of e-commerce, digital publishing, the travel side, etc., as well as, the financial services. Mm-hmm. They had been constantly facing the issues around content scraping, price scraping, some kind of form spamming, as well as also what we call skewed site analytics. So what these guys had was a very simple API-based technology, and then sort of they had ML techniques on the edges, which used to keep their signatures always up to date, and they used to scrap good bots from bad bots. And I think, again, this would largely fall in one of the second categories, what Sateesh mentioned, right, which is Indian company largely going global. I think they had they got to a stage where they had a decent critical mass in India, and then they took off in US and Europe, and they had built a very, very good substantial base in US and in Europe, and a little bit of Southeast Asia. And I think what kind of worked out for us is, again, like any other good deal, a good set of very, very complementary skill set across the founding team. I think a technology which had huge potential and very interesting sort of differentiated perspective in the form of a very unique deterministic approach that they had towards building a zero false positives, as well as very simple API integration approach, not letting the DNS rerouting, again, one of the larger companies. I think most of the existing customers, they were pained because they were having the DNS rerouting approach where essentially all the traffic were being redirected to their own servers. And none of these guys, even more so the financial services, would ever want to get into that situation, right? So I think some of these things help them get to escape velocity. And while they were in conversations with quite a few OEMs for partnership towards OEM and kind of plugging with them and then going together, that's when these opportunities came up. And there were quite a few OEM, I must confess, who I think fast-tracked the discussion. And I think that a little bit of it had also to do with how the markets, market landscape were also changing in terms of the CDNs and the VAPs, as well as, the ADCs kind of figuring it out that this is a very strong, I would say, element in their overall suite that was missing, and which most of the customers were asking. So they were heading towards build or buy, and I think that conversation kind of took up, and we saw an exit in almost a year's time. Again, this wasn't planned. I think like I said, it was more of an year-old investment, and the idea was to go along with them and scale, ramp it up even more. But I think at the end of the day, a decent outcome for all the stakeholders, and a lot of it, I must also confess, gets driven by entrepreneurs as well as the team.
Who bought the company?
So Radware, which is again a Nasdaq-listed Israeli-based company, acquired Shield Square earlier this year.
Interesting. Actually, cybersecurity is going to be interesting in that sense. I think there's going to be a lot of early exits because we've had an exit from our portfolio. Adya was bought by Qualys. And my take on this is that, the cybersecurity market has always been incredibly active from an entrepreneurial perspective, investment perspective. There's always lots of new companies coming up. And it's been true for the last 20 years that there's been so much activity in the cybersecurity space. But if you look at the enterprises and the chief information security officers, they have to evaluate so many products and so many vendors. It's kind of difficult. So for little companies to get into enterprise deals is not so simple without some sort of a partnership with a larger vendor who is already on the table, on the evaluation table at these enterprises, if it's an enterprise product in particular. So I think what's happening is that these enterprise players, the larger players who already have a seat at the table, are identifying what are the problems that need to be solved and then getting the point products into the portfolio in that same build versus buy decision that you're talking about. So I think cybersecurity is going to be a ripe area with this kind of exits on an ongoing basis. And I think it's very good for Indian companies in that space.
No, that's correct, Shramana. I think I completely agree. I mean, while these guys, you'll be surprised to know that these guys had zero, sort of sales personnel out there in U.S. Or anywhere in the globe, wherever they were getting the customers or their predominant markets were off. But I think it's largely, I think they were able to leverage this whole, what we talk about inside sales and marketing, and also the fact that it was a fairly, relatively, specifically if you look at some of the solutions that you talked about, like in cybersecurity, right? It's a very heavy integration approach. I think that's where I would say was, more like a plug and play, right? In the larger scheme of things, what they brought to the table. So it was a good combination of, very sleek inside sales marketing, complemented by a good integration, and then we're able to quickly show the ROI. But I do agree that at the end of the day, this is a space where some of these big boys, and especially the OEMs, the SIs or the ADCs and the CDNs, they're always on the watch out to make sure that their suite of offerings are full, right? Because essentially they have a much much bigger basket.
Yeah. Okay, great. Now, a couple of broad questions. If you look at your last, 12 months, 18 months of deal flow, what do you see as standout trends in the Indian market? What is happening? What do you see? What do you think is interesting?
It's from our perspective, we more look for some of the product companies or B2B companies, like I said earlier, whether it's SaaS or enterprise mobility or cybersecurity or semiconductors, hardware, digital health, medical devices. And so I think we're seeing, and our investment approach also is probably, 15, 16 investments in a fund, right, at best. So over a 3.5 year investment cycle. So you're looking at 4 or 5 investments in any year, right? So basically, we're seeing very, very good teams. Previously, we used to see a strong engineer or a marketing or a salesperson, and then they would have to go find many other executives or employees. But now the founding teams are really strong and they have complementary skills. And the product ecosystem and the enterprise ecosystem, we see a combination of returning Indians and then people who work for R&D companies in India, both MNC and successful local companies, R&D divisions, and then some of the young graduates, who have appetite to build products. I think those are the folks who are contributing or who are starting these companies. So one is the quality of the deal flow is really, really good. And, in terms of sectors, I think all the sectors that we're focusing on, I think if you look at like fintech or healthcare, I think just the way, you've seen the revolution. I mean, the mobile revolution without a lot of fixed, wire penetration in India. We've seen, again, the financial services, more people on mobile payments than people who have had bank accounts. So you leapfrog when you're a late adopter.
Yeah, leapfrog, right? Yes, exactly. There is nothing. There is such a weak healthcare sector, such a weak fintech sector or financial sector for the broad population. So this is completely an opportunity to leapfrog.
Absolutely. And so we see very, very innovative models, in that area as well. And again, Dr. Ramesh has been spending a lot of time looking at very interesting, ideas whether it is in gene sequencing, and some of them, I would not call it as 3D printing, but cell re-engineering to accelerate the pharma go-to-market. Many good digital health, AI, ML, based imaging solutions, wellness. So all of these areas, we're kind of seeing
ideas.
Very
Great.
healthy deals. So yeah.
So
All right.
if I may just very briefly, if I may just very briefly add there, Shaman, I think to summarize, while certainly B2B, given like Satish mentioned, given probably also our focus is more towards B2B, we see a lot more flow coming on the B2B side, the healthcare, the fintech. I think a couple of smaller, I would say, softer, interesting aspects is, at least, again, apart from all the sort of emerging technologies, applications, whether it's AI, ML, or building a system of intelligence, I see quite a few people coming with a distributed team, especially for global opportunities. So they having a presence in US, having a presence in India. Relatively, again, this is not like every second deal that we get is of that nature. But I think what we used to notice 4 years, 5 years back, I think now relatively I see, people in different geographies, as long as they see synergies and they understand the relevance of having someone in the US or in Europe, depending on where the global market is, they come in early on with that team. Also, the second thing is, I think, I would say they come with a lot more homework done at their end. I think decent bit of customer validation, decent bit of MVP. So it's getting farther and farther away from, I would say, just the theory and few slides. As a theoretical approach. I think it's becoming a lot more practical, and people they expect also investors to get into the practicality of what has been put together, as a theoretical plan. So I think these are some of the softer aspects.
Yeah, good, very good.
So Shamana, if I can take, go ahead.
Good.
So, if I can take a minute, just maybe give you a flavor of our portfolio, you'll understand the kinds of startups now, right? So we've invested in a company called Signy Energy. Signy is a solar storage platform, but is also a DC microgrid. After you store the energy, instead of from DC converting to AC for transmission and conversion back to DC for consumption, you have losses. They deal with the DC world, 48-old microgrid DC world. Company has done exceptionally well. Clang Labs is voice infrastructure for mobile apps, regional languages. This is the Little Eye Labs team. We were investors in Little Eye Labs. That was Facebook's first and only acquisition in India. What they're building is a voice assistant infrastructure for apps would connect to their, API. And they're doing three things. One is the regional language wrapper, and the second thing is the NLP engine to understand the intent and the inference. And third is execution on the device as opposed to cloud to reduce latency as well as cost of transaction. Right? So that's Clang Labs. We talked about Alpha ICs. We talked about Darwin Box, Ansel. Ansel is mobile, developer infrastructure, again, helping product marketing, product management teams to roll out UI personalization without development cycles involved. Again, they're a great platform, and they're a global play. Ceridian Semiconductors. Ceridian is doing 4G imaging radar chips. These imaging radar chips are used in automotive industry, industrial automation, and even drones to identify objects, high resolution at a lower cost, with high levels of integration. We've talked about Sigtipple. We've talked about Darwin Box. We talked about KIST. These are our portfolio companies, right? One that gives you a good flavor of the kinds of companies and startups that we see.
Okay, great. Well, it's been a wonderful conversation. It's good to see what you're doing, and I'm sure we'll have a chance to look at stuff together as we go along. So thank you for participating, and thank you, audience, for listening. As you know, you can come to any of the free mentoring roundtables any week that works for your schedule and bring your project. It's a safe working session. We will strategize and discuss what your options are, what obstacles you're facing, and how to remove them. And we will be back soon with another edition of the 1M by 1M podcast.